Welcome to our private equity placement model tutorial. My name is Tom Folliard. I'm the owner and developer of the CorpFin.net software. Before we begin the tutorial, let me make 3 quick points about our software. First, if you're looking for a spreadsheet-based product to create a forecast, do a private equity analysis, or to build models from scratch, you've come to the wrong place. All of our applications are web-based, our code is proprietary, and it's not downloadable into other software applications. Second, all of the CorpFin.net software applications are developed for use in our financial advisory business. The applications have been vetted and used for over 6 years by our partners, who are all experienced corporate finance practitioners and CPAs with Big Four backgrounds. Third, a 5-year financial forecast is a key component of the private equity analysis process. It would be a good idea to become familiar with our forecast models before proceeding with this tutorial. There are links on our home page to our forecast model tutorials, demos, and descriptions. As we begin this tutorial, we will first describe what a private equity placement is and a few of the key attributes of our private equity placement model. Following that, we'll create a private equity placement analysis using our model, explain the key assumptions, and review the analysis reports. Private equity placements are minority, that is less than majority, investments in existing businesses that need capital for a variety of reasons, including to expand operations, to restructure their balance sheets, to enter new markets, or to finance major business acquisitions. Generally, the businesses that seek private equity investments generate revenue and operating profits, but are not able to generate sufficient cash flows to fund new initiatives or to borrow the needed funds from senior lenders. Private equity investments can be in the form of ownership units, that is, common stock, preferred stock, partnership units, or LLC units, depending on the legal structure of the businesses, or in subordinated debt, also referred to as mezzanine capital, which are loans to businesses which require periodic interest payments and have equity features that allow holders to buy business ownership units in the future for a de minimis price per unit. Issuing new ownership interests in a business is usually very costly to existing owners in terms of the ownership give-up, the likely loss of management's prerogatives to run the business as they wish, and the potential for additional ownership dilution if the business plan on which the new equity investment is based is not accomplished. On the positive side, additional equity funding allows a business to pursue opportunities they could not otherwise undertake. The important issue for existing owners is to weigh all of the costs and risks associated with the issuance of new equity against the potential financial benefits of accomplishing the business plan that requires the new equity capital. Our private equity placement model is one of 3 robust applications nested within our 5-year financial forecast models for established startup and early-stage businesses. This design feature means that once you have completed a 5-year forecast for a company using our software, you are just a few moments and assumptions away from creating a private equity analysis which is supported by 8 comprehensive reports. We approach a private equity placement as if, theoretically, the original owners of a business and the new equity investors form a new company on the private placement date. The original investors contribute their business, which is valued at its enterprise value less its liabilities. The private placement investors contribute cash. From the private placement date through 4 years of joint ownership, both sets of investors earn the same pre-tax rate of return on their equity investments. Key valuation metrics in a private equity analysis are the estimated pre-money and post-money value of a business at the end of the company's first forecast year, and the ownership splits immediately after the equity financing. The estimated pre-money value is the value of the business, that is, its enterprise value less its liabilities, before the new equity funding is added to the company's balance sheet. The estimated post-money value of a business is equal to the sum of the pre-money value plus the amount of new equity investment minus issuance expenses. For purposes of the analysis, equity investments include any or all of the following: investments in common stock or contributed capital, investments in preferred stock, and investments in subordinated debt with warrants. Subordinated debt with warrants is a hybrid security. The principal amount of subordinated debt is not added to the post-money value of a company because subordinated debt is a debt obligation. It adds identical and offsetting amounts of assets and liabilities to a company's balance sheet and therefore provides no net change in the value of the company. While the value of warrants attached to the subordinated debt are expected to be valuable to subordinated debt investors, their value to a business at the post-money valuation date is usually immaterial. From a timing standpoint, our private equity model assumes that a private equity placement investor intends to invest in the business at the beginning of year 2 of the 5-year forecast, to maintain his ownership interest for the ensuing 4 years, and to sell his ownership interest, along with the original owners, when the business is sold at the end of the 4th year. Again, a key attribute of our model is that both the original and new investors earn the same rate of return on their equity investments from the private placement investment date through the sale of the business at the end of the 4th year of ownership. Please note that the estimated pre-money and post-money values are unique amounts that are derived from the interaction of a large number of financial forecast assumptions and investment inputs. Accordingly, changes to assumptions or inputs will result in changes in both values. Key forecast assumptions and investment inputs used to create a private equity analysis include the amounts, investment types, and pre-tax annual rates of return required on new equity and subordinated debt investments, the assets of the company at the end of the first forecast year, the sales, profit, asset, and liability management plans contained in the business's 5-year forecast, and the EBITDA multiple used at the end of the 4th year of ownership to estimate the gross selling price of the business at that point in time. That gross selling price, minus the liabilities of the company retained and paid off by investors at the end of the investor's 4 years of ownership, is a proxy for the pre-tax value of all investors' interest after 4 years of ownership. That residual value is the amount that is divided among the original and new equity investors in accordance with their respective ownership interests. Before we go through a detailed review of our private equity model, its assumptions and reports, I'm going to create a private equity valuation on the fly to show you the model's sequence of events and how easily and quickly you can produce a sophisticated analysis. We're going to create a private equity placement analysis for Company A based on a forecast we created for the company prior to this session. After we've shown you the steps, we'll go through it again in more detail. The steps for creating the private equity analysis are these. Access the member menu page and click on Create Private Equity Placement Model, which appears underneath multi-year scenario number 1. We are transferred to the private equity placement setup page. On the private equity placement setup page, we enter the gross dollar amount of common stock or contributed capital, preferred stock, and subordinated debt financing desired, and we enter our assumptions for required returns, the terminal value EBITDA multiple, and subordinated debt coupon rate. We'll enter $1 million for the common stock and $1.5 million for subordinated debt financing desired, 25% for the required rate of return on equity, 20% for the required rate of return on subordinated debt, 6.5% for the EBITDA terminal value multiple, and 10% for the coupon rate on subordinated debt. We then click on Submit to create the private equity analysis, and we are transferred to the Private Equity Model Scenario 1 page, where the analysis assumptions and reports are listed. The private equity analysis is supported by 8 comprehensive reports, which show, among other things, the details of the investment transaction, the pre- and post-money value of the business, and the financial outcomes for the original and new equity investors and the subordinated debt investors. Not considering my talking, creating this private equity analysis took less than 1 minute. Let's go through the private equity steps again and highlight the 8 reports produced by the model. Here are the steps. Prior to this session, we accessed corpfin.net, entered our login and password, accessed the secured member section of the site, established a project for Company A, and created a 5-year forecast, multi-year scenario number 1. Underneath multi-year scenario number 1, on our member menu, is an option to create private equity placement model. When we click that option, we are transferred to the private equity placement setup page. As part of the private equity model creation, our software saves a copy of the multi-year scenario to which the private equity analysis relates. That copy is automatically tagged with a unique alphanumeric suffix identifier. That identifier is repeated in the private equity analysis file names and all related reports. This identification scheme provides a complete working paper trail from the specific multi-year forecast scenario through the reports relating to the analysis. Let's now go through each of the assumptions listed on the private equity placement setup page. The amount of equity or subordinated debt desired usually is the amount that bridges the gap between what senior lenders will lend the company and the funding the company needs to achieve its long-term financial plan. One way to estimate that amount is to review the financial feasibility report generated by the business's multi-year forecast, particularly line 6, the estimated net amount of senior debt available. That line is the estimate of the company's reserve senior borrowing capacity at the forecast year ends, based on its operating plan. The line should always reflect positive numbers, plus a sizable cushion to accommodate seasonal fluctuations and operational shortfalls. The amount needed to accomplish this zero plus cushion status is a good beginning point in estimating the amount of equity financing needed. Companies with sufficient cash flow to cover interest payments, but who are at their bank's limit for senior debt, will probably want to consider subordinated debt as a partial solution to their funding needs, since the overall cost of subordinated debt is usually less than the cost of equity capital. Based on our review of Company A's financial feasibility report and its forecasted annual cash flows, we'll enter $1 million for common stock and $1.5 million for subordinated debt as our initial targets for private equity financing. The new investor's annual pre-tax rate of return target on his common and preferred stock investment is affected by a number of factors, including the level of competition among investors for private equity investments, the perceived risk associated with the investee's industry and the likelihood of achieving the forecast results, the rate of return target for the buyer's private equity fund, and possible dilution in ownership percent due to follow-on financing rounds. Generally, the higher the pre-tax rate of return required by an investor, the lower the pre-money valuation, and the lower the percent ownership retained by the original equity investors. As indicated on the menu page, a reasonable assumption for the rate of return objective for common and preferred stock is between 20 and 40%. We'll enter 25% in this illustration. The next item to enter is the annual rate of return objective on subordinated debt. Providers of subordinated debt typically want to earn a total rate of return on their investment of about 20%, with that return coming from the combination of quarterly interest payments and a share of the sales proceeds when a business is sold. As such, the higher the coupon rate on subordinated debt, the smaller the share of sales proceeds paid to subordinated debt holders when the business is sold. We'll enter 20% as the rate of return objective. The EBITDA multiple used to value the business after the investor's 4 years of ownership is a key private equity valuation assumption. EBITDA is an acronym for earnings before interest, taxes, depreciation, and amortization. It is a key operational performance metric for a business. When a multiple is applied to EBITDA, the result is an estimate of the enterprise value of a business, that is, the ongoing gross value of the business, independent of all its debts and other liabilities. Like investors' annual pre-tax rate of return targets, EBITDA multiples vary over time due to changes in various economic, credit, and competitive conditions affecting the market for business acquisitions. This schedule shows U.S. middle market EBITDA valuation multiple statistics by size of transaction from 1998 through 2009. We tend to be conservative and typically use multiples lying between the low and average multiples shown on the chart to compute the estimated terminal value of a business. We'll enter 6.5 as the estimated EBITDA terminal value multiple. The final assumption on the private equity placement setup menu is the interest rate to be paid on subordinated debt. As indicated on the menu page, A reasonable assumption for the coupon rate is between 8 and 12%. We'll enter 10%. Let's save our assumption set by clicking the Submit button. Once the assumption set is saved, the private equity analysis and all the reports related to it are created, and we are transferred to the Private Equity Scenario 1 menu page, where our initial analysis assumptions are listed, along with the reports reflecting the results of the analysis. Let's look at the Model menu page. The menu is divided into three main sections, namely the dollar amount of equity and subordinated debt financing desired section, the Review Change Analysis Criteria section, and the Review Private Equity Placement Reports section. The first two sections reflect the assumptions we entered on the Private Equity Setup page. If we wish to revise the assumptions, we enter the new assumptions and save the revised assumption set. Saving the revised assumption set recreates all of the private equity analysis reports. Let's now look at the Review Private Equity Placement section of the menu, which lists the output of the private equity model. The reports in both HTML and PDF formats are as follows. The Private Equity Placement Overview Report is a multi-page narrative report that organizes and provides an interpretation of the private equity analysis results. The report is divided into three sections, the first of which, the Executive Summary, summarizes the private equity placement results. The second section, the Introduction, provides general comments about the sensitivity of private equity analyses to financial forecasts and return criteria. The third section addresses the specific private equity valuation and describes the key drivers of the forecast and the financial metrics achieved during the forecast period. The report is organized in a manner to help the user logically present and describe the key elements and results of the analysis to a third party. The Private Equity Placement Summary Report is a comprehensive statistical report that displays the valuation results and the outcomes achieved by the original and new investors in the business. The report is divided into four sections, the first of which, the Executive Summary, summarizes the principal assumptions underlying the private equity placement and the valuation results. The second section, the Deal, lists the financial details of the estimated pre-money value of the business at the end of the first forecast year and the post-money value of the business immediately after the financing. Section 3, the Investor's Outcome, shows the net proceeds of the financing to the business, the sources and uses of funds, the interest rate paid on subordinated debt, the subordinated debt repayment terms, the forecasted gross and net value of the business at the end of 4 years, and the annual rates of return achieved by equity and subordinated debt investors compared to their target rates of return. Next is the Income Statement Report, the first of three primary financial reports, which, like other reports in this section, displays both actual and forecast data and is available in HTML and PDF formats. The second primary financial report is the Balance Sheet Report. The forecast section shows the balance sheet of the company as of the private equity placement date and at year-end for each of the succeeding 4 years. The final primary financial statement report is the Cash Flow Report. Next is the Principal Assumptions Relationships Report. The private equity placement model contains 162 assumptions in total. That's 31 income statement and balance sheet assumptions for each of the 5 forecast years, plus 7 assumptions relating to the private equity placement analysis. Finally, we have 2 financial metric and performance reports. The Financial Management Report is organized into 6 management sections: working capital, assets, liabilities, profitability, debt, and bank borrowings. The report contains 43 different metrics for each of the years displayed. Where appropriate, how the metric is calculated is displayed underneath the metric's name. The Financial Feasibility Report is a subsection of the Management Report and focuses on debt service metrics and other issues that are important to lenders. That completes our review of how to create a private equity placement analysis and the 8 reports that document the results. To recap, to create a private equity placement analysis with our software, A user must first create a 5-year financial forecast using our forecast model for either an established, startup, or early stage business. On the member menu, listed underneath that completed forecast, is an option to create private equity placement model. When the user clicks on that option, he is transferred to the private equity placement setup page, where he enters the type and amount of desired equity financing and replaces the private equity model's 4 placeholder assumptions with ones that are more relevant to his analysis. Upon submitting those assumptions, our software creates the private equity placement model relating to the multi-year forecast, and the user is transferred to the private equity scenario page, where his initial assumptions are displayed, along with 8 reports documenting the outcome of his first draft. He may change the assumptions as many times as he wishes to fine-tune his analysis. That's all there is to it. We've now reached the end of the private equity placement model tutorial. I'd like to close by repeating an idea I mentioned near the beginning of the presentation. Namely, if your objective is to generate a sophisticated private equity analysis, rather than spend your time creating and debugging your own financial model, our private equity application may be a good fit for you.